Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. European indices follow global equities higher amid easing concerns of bank failure contagion. BOE Governor Andrew Bailey boosts market sentiment, hinting rate hikes may be coming to an end. We're going to be hearing live testimony from Bailey later this hour over the collapse of SVB and the central bank's response. Plus, a U.S. regulator accuses Binance of sham compliance measures in a federal lawsuit that claims its CEO routinely broke the rules. Bitcoin slides. That rally continuing in both European equities and E-mini futures. You are looking at barely change for the S&P. That's better than what tech is doing. Tech futures are falling in the NASDAQ this morning. Some reversal of tech as a haven trade. Perhaps you don't need havens if some of the banking damage is contained. Small caps in the U.S., those are also outperforming. The selling in the German two-year continues. Yields pushing higher by about 8.5 basis points. It kicked off yesterday not just because of those easing fears of the bank contagion, but also a report that Isabel Schnabel explicitly wanted in last month's rate decision for there to be language that more hikes might be appropriate. So the most hawkish member continues to voice the most hawkish opinions. So that also means the yield differential, euro doing better than the dollar this morning, as is sterling. Cable, that's up 0.2% at 123.13, despite the fact we had Andrew Bailey yesterday saying that they wouldn't go back to pre-Great Financial Crisis rates, hinting that perhaps we're near our end. Even so, we're getting a bid to sterling. NYMEX crude, that's higher again after a monster rally today, some 5% after a closure or some troubles at a Turkish port. What's leading the market today? Most of these regional indexes are in the green. The biggest gainer is energy, it's raw materials, it's those very economically sensitive sectors. Even banks are one of the best performing sectors. It's a near inverse of what the market has done over the past 2 weeks. Again, it lends its hand to this idea that at least for today and yesterday, we're less concerned about these banking issues. But speaking of which, in a congressional hearing today, the Treasury's top domestic policy official is expected to pledge that regulators will take all necessary action that Americans' deposits will be safe. For more on this, let's bring in Bloomberg's Valerie Teitel. Val, I know that this was a really big sticking point for markets. People wanted assurance that their deposits are safe, and we had these prepared remarks. So did we get that assurance?
Yeah, so from the Treasury Undersecretary for Domestic Finance, Nellie Lang, she did release those remarks that she prepares to give the Senate today. And she did hint that she is emphasizing how important regional banks are to the U.S. economy. She's possibly going to try to restore some comments after the miscommunication missteps from Yellen last week around uninsured deposits. We also hear from Fed Vice Chair for Supervision, Michael Barr. Now, in his pre-release text, he hinted at further expansion of regulation, talking about different stress tests they expect to put banks under, maybe perhaps a change in the liquidity rules when it comes to smaller U.S. banks. And lastly, we hear from the FDIC chairman. They announced that they are launching a probe into Silicon Valley Bank's management. And they also revealed that the 10 largest deposit accounts at SVB held over $13 billion.
Valerie, it's another day in the markets, a second day of stocks higher, yields higher, too. Is this the market assuming the bank wobbles are over?
It's definitely been a week of optimism so far. The intraday swing in the two-year yield in the last two sessions was nearly 45 basis points, climbing 45 basis points on optimism that these banking wobbles could be over and the Fed could hike rates in May. We're actually now pricing even odds for that Fed rate hike on May 3rd. But there is a lot of those maybe rolling their eyes at the recent optimism. Jeffrey Gundlach, in an interview with CNBC yesterday, stated that he expects the Fed to still cut rates at the later half of this year and expects a contraction of growth. Now, I've got another BTV which shows just how heavily discounted regional bank stocks and just bank stocks as a whole in the U.S., how heavily discounted they're still trading. It goes to show that we might be set up for quite a brutal bear market rally.
Can I just say, Gundlach also tweeted that opinion, and in it he said, but I'm wrong 30% of the time, so keep that in mind, too. Valerie, thank you so much. Bloomberg's Valerie Teitel. Joining us now for our markets conversation this morning is Hugh Gimber, global market strategist at JPMorgan Asset Management, and Bloomberg's Francine Lacqua. Thank you both so much for joining this morning. Francine, can you just set up this debate that's unfolding? Because markets have backed off some of the rate cut bets, not totally, but different investment houses are now acting against each other in terms of whether they believe cuts are coming or not.
Absolutely, Danny. And that is the big question, right? Is that are the banking wobbles over enough that we can refocus back on inflation and really do away with those rate cut bets? I mean, that's certainly the view of BlackRock. And just sticking with what we've seen in terms of the messaging from Fed, other central banks as well, that inflation remains the priority. But then good luck, of course, on the other hand, insisting that no, a recession is coming and the Fed needs to cut, very much stemming from the recent turmoil that we've seen. And I think what's really causing a lot of the debate is just the idea of, the fact that there is this longer term strategy to tackle inflation and really get that under control by central banks. And that's all well and good. But then when things like short term stresses in the banking sector rear its head, you really get to see just how fragile the global market economic system is. You have a lot of kind of powder kegs just waiting to explode at the moment, and it really is not going to take much. And this is why we've seen, I think, a lot of jitters around this banking sector, because people are thinking maybe this is the straw that breaks the camel's back.
Hugh, where do you stand on this? Is the market right to price in cuts for this year?
I think the market's right to price a Fed pause, because you go back a few weeks, there were good reasons, even before any of the banking stress that we've seen, for the Fed to be thinking that it was starting to break the back of inflation. The bulk of the inflation that's left in the US is in the most lagging parts of the basket, right? It's shelter, it's services. We know these things are going to take some time. So I think there's a clear case now for the Fed to hit pause. The question then in the second half of the year is how big the feed through from a deterioration in lending standards is to really get inflation lower towards target. And I'm not convinced we're going to see that quickly. So when I look at the market pricing significant cuts for the second half, I think really you'd need a pretty significant economic shock to get there. I'm more in the camp that it's higher for longer and the Fed hits pause, but then rate cuts are more of a 2024 story.
The corporate story also seems to feed into this, Hugh, because companies are still hiking prices and they're being rewarded for doing so. Shareholders prefer they have higher prices versus higher sales volume. To me, that seems like very sticky inflation. Can the Fed really afford to pause even?
So I think they can, because when you see the progress that we've been making over the course of this year, you've had the energy price move come down, you've had now a clear deterioration in goods prices as well. And we know that over time, shelter, for example, when you look at some of the more forward-looking indicators on rental data, that's just going to take some time. There's no real benefit for the Fed to keep chasing this with higher and higher rates, because if they do, you're going to get a much bigger economic shock at the end of it.
And Francine, the recession bets, they are starting to unfold. We're seeing, I know this was a debate end of last year before all of this started to happen, but it's coming back, this conversation of if we're heading in towards a recession, what suffers, what does well.
Absolutely, Danny. I mean, it is quite a far cry from the no landing scenario that was being floated around at the start of this year, right? But yeah, I think recession bets very much coming back to the fore. And of course, a lot of investment houses trying to position for that. We've seen kind of bets in junk bonds, for instance. I mean, the argument there, I think, is that, yes, this sector will suffer during a recessionary period, but it's also probably going to be the first ones out of the gate to rally once we get past that. That's quite a long way, though. I think, it's a sort of trade that you have to be ready to make and sit on losses for a little while before it starts paying off. But certainly people are thinking about this.
Yeah, well, you know who is thinking about that? Your colleague Coleman over in the U.S. at JPMorgan Asset Management. But to the point of junk bonds, if you look at spreads at this moment, they're still under 500 basis points. Junk bond spreads about 60 basis points wider since March 10th. But that move is really dictated by treasuries. Are you surprised that spreads didn't widen more in this episode?
So corporate fundamentals are still pretty solid, right? We've seen a significant improvement in net leverage ratios. We've seen maturity walls pushed out to 25, 26. So I think there's a good reason to explain why we don't need to see the same kind of recessionary levels that you'd expect from high yield this time round. right? I don't think we're going to get back to 800 to 1,000 basis points over this time. But still, as you say, with spreads under 500 basis points, I don't think that's offering compelling value here. So the high yield call for me is probably one that's more the second half of this year, looking at something around 600 to 700 basis points. So below sort of typical recessionary levels, but significantly above where we are. That for me is where high yield starts to get a lot more interesting.
How do you think about this equity market, Hugh? I love what you put in your notes, that equities are rallying on this idea of cuts, but the rally overlooks why rate cuts would come. Are we just whistling past the graveyard right now?
So my fear at the moment is that investors are almost dusting off the playbook of the last 10 years, which is rate cuts are coming, therefore go and buy growth, equities rally. But we are in a very different environment today. We're not in the period that we've seen before where rate cuts are coming because inflation's too low and central banks are trying to get growth going. Rate cuts are being priced because there's a significant risk of an economic shock. And so that, for me, makes me a little bit more nervous about the strength that we're seeing in equities at the moment. And I think it's much more important to be focused on more defensive exposures within the equity market. The nice thing now is that there are plenty of options to do that. So this time last year, you were trying to find some of those lower beta sectors, places like utilities or staples, but they were looking very expensive. Now you've seen valuations come off. And so I think it's all about quality within equities. This is really the kind of boring metrics like resilient earnings, like dividend payers that have been out of fashion for a long time. I think there's really good opportunity to be found there now.
Hey, considering the whiplash in this market, I am all for a boring investment strategy at this point. Hugh, Christine, thank you both so much for joining this morning. That's Hugh Gimber, Global Market Strategist at JPMorgan Asset Management, and our very own Christine Aquino. Coming up on the program, the U.S. regulators have taken its most forceful step yet to crack down on crypto exchange Binance. We'll have those details for you next on Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. U.S. regulators have accused Binance and its CEO of routinely breaking derivatives rules, an allegation which the chief executive has called, quote, unexpected and disappointing. Joining us now is Bloomberg senior crypto editor Anna Herrera. Anna, what exactly are U.S. regulators alleging here?
Basically, the thrust of it is that Binance allowed U.S. customers on its global platform, which you're not allowed to unless you register. So that's the main point of the lawsuit. But the lawsuit was quite long and contained various allegations around lack of KYC, so know your customer rules, controls, which is important, right? Because that's the way you know where your customers are coming from. And then obviously it said that for years they let U.S. customers join on the platform, which again you're not really allowed to, and that's a pretty big deal.
Certainly, and we're also in this point right now where the previous big name in crypto was FTX. That, of course, is not anymore. So here you have Binance coming in, CZ, as sort of the next big player. So what does it mean for sentiment if the next big fish is now coming under scrutiny?
So surprisingly, sentiment was hit yesterday, but is now somewhat recovered. It wasn't as big of a blow as you would imagine on prices. I think in a way, people have been saying it was like an open secret that you were allowed to trade. And if you think about it, the allegations sort of include long lists of like big trading firms, examples of big trading firms. They don't mention them by name trading on the platform. So if those trading firms were on the platform and were in the US, then you'd expect people to know. And so, there wasn't that much of an impact. But obviously, this is a serious lawsuit. And so maybe going forward, there might be more impact on prices or on the platform itself, on trading volumes on it, and where do people go and trade if they don't trade on Binance.
Okay, so story still ongoing. Anna, thank you very much for joining us. That's Anna Herrera, Bloomberg senior crypto editor. Now let's get to your first word news. With that is Leanne Gerrans. Hi, Leanne.
Hi, Danny. Police in the US say the suspect in a Nashville school shooting had drawn a detailed map of the building before killing 6 people, including 3 9-year-old children. Police shot dead the attacker, who they have named as a 28-year-old former student. Following the tragedy, President Joe Biden again called on Congress to ban assault weapons, saying gun violence is ripping at the soul of the nation. Now, the US Federal Deposit Insurance Corporation has launched investigations into the conduct of managers at SVB and Signature Bank to determine what led to their collapse. The FDIC chairman told a Senate committee that directors, officers and other parties will now be held accountable. And the chairman of Barclays has described recent allegations against former CEO Jez Staley over his relationship with Jeffrey Epstein as, quote, serious and new. It's the lender's first update on the matter since Staley left the bank in November 2021. Staley quit as Barclays boss after UK regulators found he had underplayed his relationship with the convicted sex offender. Staley is challenging those findings. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Danny.
Leanne, thank you very much. Coming up, controversial plans for judicial reform have been delayed in Israel. More on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. UK bonds selling off across the curve, yields pushing higher by as much as 10 basis points in the 10-year. We're going to hear testimony from BOE Governor Andrew Bailey in just about 20 minutes' time. Now let's turn to Israel, where Benjamin Netanyahu has delayed his controversial judicial reforms to prevent the country from being, quote, torn to shreds. It comes after tens of thousands of demonstrators took to the streets last night. Bloomberg Israel Bureau Chief and Senior Middle East Editor Ethan Broner joins us now. Ethan, what's the mood like in the country after this announcement?
Well, I'd say it's a mixture of relief and exhaustion and anticipation about where this will go. It's right now the parties that are involved are forming little negotiation committees. They're eventually going to go to the president's house and try to pick up to sort of figure out how to move forward on this judicial question. I think the problem, though, remains that in some fashion it's been kicked down the road. It seems much less likely that a radical set of proposals will pass or be accepted. But the question is, how moderate will they be and how much of a difference that will make, and whether a kind of political force of the secular left has been awakened that will, in fact, make a big difference in coming months. It might be.
So does that mean we might not see that big of a compromise when these discussions take place over the reforms?
Well, I think we will see a big compromise, but I don't know how big. And there's a question of how to choose judges. There's a question of whether the Knesset, the parliament, could overturn a decision by the Supreme Court. These are the things that are, I think, going to be on the table right now. But I think the key is going to be whether the two sides can agree that this is all they're going to focus on, or whether there are going to be other things there. Don't forget, he fired his defense minister a couple of nights ago, and so we have to see whether he will get reinstated, and if he's not, what impact that will have. So I think it's an important and a very complicated moment for Netanyahu, who's been a bit of a magician politically in this country for a long time, and maybe running out of rabbits to pull out of a hat, or maybe not.
Ethan, thank you very much. Rabbits and all. Bloomberg's Ethan Broner there. Now, French unions also have been striking nationwide again today over President Emmanuel Macron's plan to raise the minimum retirement age by 2 years to 64. That's happening over mounting concerns with violence between protesters and riot police. For more on this, let's get to Bloomberg's Caroline Conan, who's outside in Paris. Caroline, what are we expecting today when it comes to further protests?
it is possible that we're going to see some violence again on the sidelines of those protests. Unions are expecting to do better than the 1.1 million protesters that you had last Thursday for the last protest against the pension reform. But what the government and the police doesn't want to see is this, those so-called black blocs, those far left groups who are usually causing the violence on the sidelines and clashing with the police. So there will be about 13,000 anti-riots and police officers around the country today, and 5,000 in Paris in order to contain this violence. As you can see, some shops, some banks, just like BNP Paribas behind me, has already barricaded their windows in order to avoid these windows being smashed during the protest. And you'll still see some disruptions in the transport sector. You have about half of regional trains cancelled today, and also in schools, in gas stations, about 15% of gas stations are missing at least one type of fuel. Finally, Danny, one improvement though is on the garbage front. There's been a lot of trucks and private companies actually making rounds around Paris, and the garbage piles have started to recede.
Caroline, thank you very much. Bloomberg's Caroline Conan there. It is worth noting, it's happened very slowly, but the spread between French yields and Germany have been expanding, perhaps pricing in some of that political uncertainty. Elsewhere, though, in Europe, it is a day of rallying, about a third of a percent on the overall benchmark. Some of those more risky type sectors like energy are doing better this morning. But coming up, we're going to talk ECB. Isabel Schnabel pushing for more hawkish language. This is Bloomberg. European indices follow global equities higher amid easing concerns of bank failure contagion. BOE Governor Andrew Bailey boosts market sentiment, hinting rate hikes may be coming to an end. We're going to be hearing live testimony from Bailey later this hour for the collapse of SVB and the central bank's response. Plus, a U.S. regulator accuses Binance of sham compliance measures in a federal lawsuit that claims its CEO routinely broke the rules. Bitcoin slides. Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. We do have a pre-market reading on some of the U.S. Regional banks. First Republic, it gained some 12% yesterday, is up another 5.5%. PacWest, another regional bank, up nearly 1.7%. I should point out, though, First Republic, even though it gained 12% yesterday, is still down 80% from March 10th. So it has a whole lot of ground to make up for. Now, as investors navigate this turmoil, the banking turmoil, so do central bankers. ECB Executive Board member Isabel Schnabel is said to be pushing for explicit wording on future rate hikes in this month's decision statement. Joining us now is Melanie Baker, senior economist at Royal London Asset Management. I should say, as you might imagine, specifically what Schnabel is calling for is to saying that there are possibly more rate hikes to come. Bonds seem like they're being sold off on this, but I can't help but wonder if the fact that this wasn't included in the last statement, the fact that Christine Lagarde said it verbally, but the statement itself was a little bit less clear about that, does that not mean that the doves have a pretty strong hold at the ECB still?
I don't necessarily think so. I mean, it's not just Schnabel. If you look at the commentary we've seen from ECB members since the meeting, it has been relatively consistent. And we have heard from a couple of the doves, of course, but many of them are those you consider more on the hawkish side. And generally, the messaging it's data dependent, but they keep returning to this message that if their central forecasts remain intact, they don't get knocked off course by all the financial volatility, tighter credit conditions, they have got more work to do. That seems a relatively consistent messaging from them, I think, since the meeting.
But is it fair to say that that turmoil is contained in Europe for now?
It's very hard to say. I kind of felt like that earlier last week, and then it didn't feel like that, and then so
changes every day, every minute.
I think it's too early, but I hope so.
So does that mean then that there's this potential for the ECB to be heading towards a policy mistake? That it becomes a repeat of 2008, and they need to cut soon thereafter?
I think there could be a policy mistake at this moment from all the central banks in either direction, right, which is part of the problem. I think that's why they're trying to be a bit more pragmatic and very data dependent, looking at the evidence as it comes in and watching those credit conditions and, really trying to take time to decide which is the right path. I think it's very difficult for central banks here.
Yeah, I just want to point out we are getting some Enria from the ECB speaking, saying that they shouldn't, Mueller first off said that they shouldn't fear bank woes spreading to the Eurozone. And Rhea is talking specifically about the CDS market, about scrutinizing it. But I want to go back to this idea of banking woes in Europe. We've talked a lot on this program about the idea that it would tighten credit conditions in the U.S. And that makes sense to me because these regional banks, of course, so important for lending in the American economy. How would that play out in Europe in terms of this episode tightening credit conditions?
I mean, not necessarily quite as directly, but I think once you get worries about banks and the banking system, and it feeds through as well, I think, into expectations around the economy, it feeds through potentially into business confidence and things as well. It's a natural environment where you'd expect banks to maybe pull back a bit, be a bit more cautious on their lending. So it may be a more sort of generalised effect rather than associated with a couple of specific banks. But nevertheless, I think it's something that, economists are watching out for.
How about in the UK, how fragile are we at this moment in terms of the BOE continuing to hike and something else breaking?
I think they probably will have to continue to hike. I think that's related to quite strong underlying domestic inflation pressures as I see them. At the moment, the banking system, the UK isn't the centre of attention on that side. But of course, again, I think from a central bank perspective, it's not really, when they think about monetary policy, it's not really about the financial instability as such. It's about, again, how it feeds through into credit conditions and the real economy, into sentiment, how it feeds through into bank lending practices. At the moment, I think we're still on track for further rate hikes in the Bank of England.
Can you talk to me about your outlook for inflation? Because that above 10% reading did catch a lot of people by surprise. What are those domestic factors that is keeping inflation so sticky here?
It's general behaviour by companies, how they're able and willing to pass on price increases, cost increases as they're coming through. I think that's partly related to inflation expectations, and then there's, of course, a wage element. So we are seeing quite strong wage growth still in the UK, particularly in the private sector. So that's feeding through as well. So generally, when I'm looking at inflation, I'm separating things out. And in the UK, I'm particularly focused on, for example, services inflation, which just it's very strong and it's not coming down on a sustainable basis.
Well, then there's that element of demand coming into it, too. If not only corporates are raising prices, but people are willing to pay it. Does that not need to suggest, not that the BOE needs to keep going, but that they need to tighten a whole heck of a lot more?
Potentially. That's certainly a risk scenario. I'm not assuming that they're going to have to tighten a hell of a lot more, as you say. But I do think that the messaging could have been a little bit different. One thing they could do is to continually re-emphasise that they are very serious about hitting the inflation target and tighten up some of that messaging. The Bank of England have been quite quiet in periods compared to other central banks.
And well, we did hear from Andrew Bailey yesterday, but he had said that rates are not going to go back to their pre-crisis level. Is that problematic, though, the fact that he's ruling out what the ceiling could be already?
I don't think central banks will ever rule out anything. I mean, something we've got that shown. But I wouldn't be surprised if you see that kind of statement coming out from several central banks. They really don't want to get down to the point again where you're effectively at zero interest rates. And at the moment now they have quite a cushion to cut rates. It sort of makes sense in that environment, but I doubt that they're really ruling anything out.
Well, I think it's more so pre-global financial crisis levels in that where they were before they started to cut rates. But then again, the argument often with the UK is that the economy is so sensitive to rate hikes, especially looking at mortgages in the tie to that. So isn't there just then mechanically a ceiling of how much the BOE can hike because it would snowball pretty quickly?
That's a really good question, and I don't think we have a great feel for that. I think one of the issues is clearly that the mortgage market has changed. Right, so people have this increased preference for 3 to 5 year mortgages, whereas several years ago, a decade ago, say, you'd be looking at more variable rates in the mix. So that sensitivity, I think, has changed. It makes life a little bit more difficult. I think these hikes that we have seen will feed through into the UK economy, but they may take a little bit longer than we've perhaps been used to.
One of the other things I've been thinking about a lot is the fact that energy prices have fallen. But that hasn't translated into lower inflation necessarily. Is there a risk that inflation actually becomes more entrenched? Because all of a sudden you look at your energy bill, it's lower, and you say, okay, that means I can go out to dinner. I can go spend more money. I can go buy that thing that I've been wanting to.
That's a really good question. I mean, I think we will see that real pull down from energy prices from Europe, for example. I think when we get the data towards the later this week, the European inflation data, you will have seen exactly that base effect, negative base effect, really coming through. But I think you're absolutely right. There is a risk there that financial volatility doesn't weigh down on credit conditions, and we go back into that situation where it's kind of good news is bad news. So demand data comes out strong, we have strong employment data, strong jobs data, and it just means the central banks are going to have to hike more.
All right, Melanie, really great speaking with you this morning. That's Melanie Baker, senior economist at Royal London Asset Management. Coming up, it's not quite a fairy tale for Disney. The world's largest entertainment company is cutting jobs this week. Its veteran CEO, Bob Iger, attempts to save the company billions. More on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Walt Disney, the world's largest entertainment company, will begin its first of 3 rounds of job cuts this week. In a bid to save over $5 billion, 7,000 jobs are going to be cut. For more, let's get to Bloomberg Quick Take correspondent Alex Webb. Alex, what's the thinking here behind these job cuts?
The thing you need to think about is that early in the pandemic, back in 2020, Disney had an activist investor that came in and said, you need to be more like Netflix, become a growth stock, double down on Disney+. And if you look at what was happening with their price to earnings ratios at that stage, Disney was trading at about 20 times its forward earnings. Netflix was in the sort of 50-time range. Disney did that. It doubled down Disney+, scrapped the dividend. The price to earnings ratio went through the roof, went to 70 to 80 times forward earnings. Now, as people coming out of the pandemic didn't have as much time to spend on Disney+, that meant those price-to-earnings ratios came down again. So Disney's now at 20 times forward earnings again, exactly where it was in sort of 2019. You can see that in this chart right now. The price-to-earnings chart is on a screen somewhere, but not on your screen. Anyway. What we've seen then is that they're trying to correct that, cut their costs in order to try and resurrect the share price.
See, that's TV magic.
Here we go. We've got it finally. So you can see this here. Disney's the white line. Netflix is the blue line. Netflix, massive premium to Disney back in 2019, 2020. Disney changes policy in sort of March 2020. Share price goes through the roof. Then we see the gradual, steady decline, and they're back to where they started.
This is so fascinating because it's not just Disney changing tack. It's almost them going from, we wanted to be a growth stock, but now we want to be a value stock.
Exactly. And it's a thing that a lot of actually tech companies as well are thinking about right now. Actually, is there much legs in being a growth stock when we've seen, interest rates go through the climb significantly, if not go through the roof? And it is a question that therefore a lot of people are having to ask themselves.
Does that mean the metaverse no more? I mean, I know we had that Wall Street Journal report that Disney was just going to cut its metaverse unit. I was talking to you about this earlier. I didn't even know Disney had a metaverse unit.
Well, the metaverse was a very buzzy word that actually made investors, companies like to say, because it suggested to investors that they were forward-thinking, they were spinning into this big new technology. Facebook rebranded itself as Meta. Notice in the past two earnings calls, Facebook has barely mentioned the word metaverse. It has also cut a whole bunch of jobs. Disney is following suit on that case as well.
What does that mean for the future of metaverse investments? Is it a metaverse winter, if I may call it that?
Well, this is always going to be a technology that is a good few years away. It's interesting seeing Mark Gurman's reporting over the past few days about Apple. Apple had a big meeting with their top 100 executives where they showed off internally what they're doing in augmented reality, virtual reality, headwear. They said to their employees that it's going to be about, in the near term at least, about as big as the Apple Watch. They should think about it in that trajectory. The early years of the Apple Watch wasn't very big at all. The Apple Watch also has not spun up a huge secondary market of people playing into that, right? So it's a useful lens through which to consider it.
Interesting. Alex, thank you very much. That's Bloomberg's Alex Webb, the latest on tech. Now, just about an hour and 43 minutes into this trading day, European equities are moving higher. So are U.S. futures, but only for the Dow and small cap. The main indice, E-mini futures, are flat to down. NASDAQ underperforming, tech down 0.25%. It's the unwind of the trade over the past 2 weeks where tech was the haven amid the turmoil. It still is up, though, on the month, still the best performing sector in American equity. Coming up, BOE Governor Andrew Bailey is set to be quizzed by the UK Parliament's Treasury Committee shortly. We're going to bring you that live as it happens. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. In just a moment, we're going to be going live to testimony from the Bank of England governor over the collapse of Silicon Valley Bank and its effect on the UK. But first, let's take a look at some of the other top stories this morning. Prices in UK stores reached record highs this month in a sign that the cost of living crisis is far from over. Annual grocery price inflation soared to 17.5%, according to data compiled by market research group Kantar. The CEO of HSBC's Australia unit has defended the lender's acquisition of Silicon Valley Bank's UK arm. Anthony Shaw said the deal made great sense and had nothing to do with pressure from regulators. HSBC paid £1 for the business earlier this month, shortly after the bank's collapse. BOE Governor Andrew Bailey says interest rates will probably remain below the highs seen before the financial crisis. It's his latest hint that the UK central bank may be near the ending to its rate hike cycle. He also said that rate decisions won't be affected by the global banking crisis. Now, despite that language from Bailey, despite Bailey saying that we won't go back to the high in rates, what are we getting? We are getting a sell-off in gilts. UK 10-year yield, that is up 9 basis points, a second day of selling. That rate differential, we're not seeing as big of a move in the U.S., means that sterling is heading higher. It's off the highs of the day, but still just below 1.23. Meanwhile, the FTSE 100, that is able to climb up some 0.3%. It is energy that is leading this equity market throughout Europe. Of course, we know a lot of the oil majors live in the FTSE 100, so that is aiding the gains we're seeing in the UK bond market. But still, the attention goes, I should say, to the bond market. It goes there because we continue to see a sell-off following the big rally we saw over the past 2 weeks. Now, in terms of that rally, it was dictated by the fact there was turmoil in the U.S. over banking that spilled over. It spilled over into what's happening in Europe. Now, we're going to shortly be hearing from the Bank of England Governor Andrew Bailey and other senior BOE officials. They're going to be set to give evidence to UK Parliament's Treasury Committee on the collapse and rescue of Silicon Valley Bank UK. Officials are also expected to be quizzed on distress seen in the wider banking sector, including the fallout of Credit Suisse. We're waiting for that testimony any moment now. But first, let's bring in Bloomberg's Tom Metcalf. Tom, this is the thing, in terms of spillover effect into the UK, it doesn't seem to be a massive one. SVB UK was bought pretty quickly by HSBC. So what might the concern then be for Andrew Bailey?
Yeah, I think it's going to be interesting to see how he characterises what happened. I think you're right. I think from a regulatory point of view, they're probably quite happy with how it went, right? Like HSBC was seen as pretty much the ideal buyer. There was not much need for government support. There's, very minor guarantees required. So that's really good news to the regulators and the government. That's what they wanted. But yeah, I think for me, it will be interesting to hear, is there sort of any nuance here? Is Andrew Bailey suggesting, perhaps they should have let SVB UK fail, for example, on an outlier point, because we understand that the Treasury, separate to the Bank of England, were much more keener to kind of make sure there was a rescue in place to protect that tech environment. So be interested to see if there is any kind of gaps between the Treasury and the Bank of England.
Yeah, I was going to say, here's the man himself. We are expecting to hear him speaking shortly. If you want to watch it on your terminal, it's live go. As soon as he starts speaking, we'll bring that to you. So it might be a very nuanced point, he says. I got to say, if he says they should have let SVB fail UK, that will be very fascinating. I'm sure get a lot of headlines. In terms of UK banks, what has the language been in terms of their strength or fragility?
I think they've been relatively insulated. So I think, none of the UK banks are seen as being particularly undercapitalised. I think, the kind of this ring fencing regime they brought in after the last financial crisis is seen to be sort of adding a lot of stability. So
relatively speaking, they're not kind of in their sort of targets of investors, as it were, yet. But you've still seen these shares massively drop. They're now coming up again after sort of last week's sort of volatility. So look, the sector is still under strain, and I suspect it will be kind of being, the messaging will be like, we're watching very closely, but we're kind of comfortable with the arrangements we have currently.
Okay, well, let's listen in for a few moments here to this testimony from Andrew Bailey.
Since Barings, actually, I'd say. I mean, Barings, as you'll remember, was a sort of Friday to Sunday thing, and this was pretty similar. So, yes, I mean, I would, if you don't mind, draw a distinction with Credit Suisse, which we might come on to, which is actually a much more drawn-out affair. But yes, it was a very fast passage to failure.
So you mentioned Credit Suisse, their governor, and obviously quite a few of banking stocks, regional banks in the US. We've heard in recent days pressure on the share price of Deutsche Bank and so on. You probably won't want to comment on areas outside the UK, but I just wondered whether you think today that these individual idiosyncratic events are now past and that things have settled down and this turmoil in the banking sector in March is behind us.
Well, we've sent you an assessment of the UK banking sector, and obviously we'd be very happy to discuss any points you want to discuss out of that. I think the US authorities are still dealing with some of the consequences of the issue in the regional banks that manifested itself in Silicon Valley Bank. I think Credit Suisse, I would say, well, obviously, as you say, come on to happy to talk about that. Is a rather institutional specific story about long run issues in the institution. So my view, and my very strong view with the UK banking system is that it is in a strong position, both capital and liquidity wise. It is not showing signs of problems in that respect, and we tested, as you know, very extensively. I also think that what we saw at the tail end of last week, Friday in particular, when there were quite sharp market movements. I think there are moves in markets to, if you like, test out firms. I would not want to say that those, in my estimation, are based on identified weaknesses more than testing out. I mean, there is quite a bit of testing out going on at the moment, I think.
And last September, obviously, there was the stress test of the liability-driven investing, which was way outside the parameters of any stress test that you had run. Sam, have any of these developments been outside the stress tests of the sorts of things that you model for?
Well, I'd make a distinction here between the capital treatment of interest rate risk, which was a relevant factor in the demise of the parent bank, Silicon Valley. We do capitalise that risk very thoroughly for UK banks, including, by the way, for Silicon Valley Bank UK. And I'm entirely content that the stresses we've seen are inside the types of stresses that we apply for capital purposes. Where I think there might be more of a policy question, it's an international question in which we'll take a close interest, is around the calibration of the liquidity coverage ratio. So that's the sort of 1 month liquidity, if you like, the banks have to hold. And as Andrew
So speaking there is the head of the Prudential Regulatory Authority, Sam Woods, about the stress test done by the BOE. We heard just moments ago from BOE Governor Andrew Bailey. They are being questioned by Harriet Baldwin, the chair of the Treasury Select Committee. Really fascinating that Bailey talked about the moves in the markets being ones that test out firms, saying it's not a reflection of any weakness. Instead, just testing them out. So kind of hitting out at the vigilantes in this market. Also saying that it is his strong opinion that UK banks are in a strong position, both capital and liquidity-wise. They're not showing any signs of a problem. We're going to keep an eye on that testimony as BOE officials, Bailey, Woods, other testify at the UK Treasury hearing on rescuing Silicon Valley Bank UK. You can watch in and listen in at LiveGo on your Bloomberg terminal. This is Bloomberg.
Stress test for when you're looking at some of these rules.
Yeah, I think that's right. I mean, all of us could move money.
The issue for us is persistence, is what happens thereafter, really, actually, and what the underlying level of core inflation is in the economy.
The economy is darkening, even if it doesn't lead to a crisis in the immediate term. It is signaling that monetary policy is getting tighter. Central banks are still hiking interest rates.
The bottom line is that we already had a slowdown coming because of the lagged effects of Fed hikes, and now we're adding onto that a banking crisis, and that, of course, increases the risks that the slowdown is going to be faster.
I don't think we're quite out of the woods yet.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Bank of England governor testifies on the impact of the Silicon Valley Bank collapse, saying UK banks are in a strong position. Later today, US lawmakers face off with the Fed, FDIC, and Treasury officials over the bank failures. Binance says it's disappointed with that lawsuit from US regulators. The cryptocurrency exchange and the CEO, Changpeng Zhao, are accused of routinely breaking derivatives rules. And Israel's Prime Minister Benjamin Netanyahu is delaying a controversial plan to overhaul the judicial system. Still, thousands of demonstrators opposed to the plan were back on the streets overnight. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, on both sides of the Atlantic, we look as if we're going to learn quite a bit today about the SVB collapse, about the saving of certain businesses or the putting together deals to buy certain businesses on both sides of the Atlantic. But in terms of markets, we're trying for a second day to rally back from Friday's losses.
Yeah, we're trying, and we could be helped actually a little bit by China. Just saw a headline cross that Alibaba is free to pursue IPOs as well as other corporate finance moves whenever it's ready. And that is really interesting, especially when you add to that the fact that Jack Ma reportedly showed up in China again yesterday for the first time in, a year, at least a year, many years. Take a look at what we got going on in terms of the markets right now. S&P futures, which are down, are coming back to unchanged. We did finish in the green yesterday, only slightly, but we had banks leading the way as technology lost some of the gains it had made. Back up over 4,000 on S&P futures, as if none of this banking turmoil really ever happened. The U.S. 10-year yield rising a bit, 4 basis points at 356, 357 right now. So not a lot of movement there. There was more movement. There's more movement at the beginning and the end of the curve in the 2s and the 30s, for example. But the 10s are moving a little bit. Investors letting go of that debt, which I guess is good news for risk assets, as you see S&P futures now turn green. NYMEX crude right now at up 57 cents, 73.38 a barrel. This after really big gains yesterday. I think we were at 4 or 5% on WTI. We were under $70 a barrel when we looked at this quote yesterday, and that was gaining at the time. So we've come a long way back on crude. So watch for sure the oil producers that are so strong. I'm sure we'll see that show up in the European trade today. And then Bitcoin. Right now, it's down $27.59, but it's over $27,000. So it had come down a lot on the Binance news that we got yesterday. We're going to talk about that today, the CFTC suit and the other regulators that are looking at Binance, putting pressure on Bitcoin. But it's still, I think a lot of people would say, shockingly stable, considering all of the turmoil around crypto. Take a look at what's going on in Asia. Of course, those markets are closed for the most part right now, and so they won't be moved by the Alibaba headlines. But you did have a finish higher on the MSCI Asia Pacific, about 0.6%. The Nikkei in Japan up about 0.1%, and the dollar weakening against the yen. So the Bloomberg Dollar Index more broadly is down, which seems to augur well for risk assets, right? But as the yen gets stronger, maybe there's a little bit of a safe haven bid there. And then finally, we saw the CSI 300 closing down about 1/3% at 39.99. But as I say, this is before the Alibaba headlines crossed. Anna, what do you see in Europe?
Yeah, well, we'll see whether that Alibaba story then, Matt, develops into something that is just about the business, significant as that is, or something broader about the extent to which technology is going to be regulated, clamped down on or not in China. That would seem to be a really interesting dynamic there. Here in Europe, we are seeing some strength coming through on European equity markets as we try for another day to bounce back from those losses during Friday's session. We were down 1.5% on many of these continental European markets during Friday. Yesterday, we bounced back some way, and today we try and complete that picture, if you like, try and complete complete the picture. And some of it is being driven by the bank sector. But to Matt, your point about energy, it is certainly not all about banks. So let's have a look at where we are on the oil markets, because that is a crucial part of what we're seeing today. We saw oil prices rally by more than 5% at one point yesterday. So that was a substantial move on the WTI price. This is Brent crude. And just in today's session, we're adding another 0.6% there. So from the low 70s back up to $78 as the handle on Brent crude. There's some specifics around a Turkish pipeline. There's also the dynamic around Chinese demand versus US recession. How does that all play out? But for the moment, a little bit of strength returning to the energy market. And that is sending shares in that sector a lot higher. So we're up by 1.5% for the energy names here in Europe. We don't want to take our eyes off banks for too long. We'll get to some of the news flow surrounding the banking sector, some of that coming through here in the UK just in the last few minutes. We'll get to that in a moment. But in the meantime, here's where we are on the banking story. So still staging something of a rebound from the selling that we saw on Friday, up by 0.8% in today's session. And here we have an 11 basis point move on the UK 10-year gilt yield. And I put that in, but we could be talking about treasuries, we could be talking about European yields, because it seems as if there's some sort of concerted move higher, as if we are increasingly able to separate out the financial policy issues surrounding banking and monetary policy, and maybe returning to the idea, Matt, that, you know, there are going to be, in some cases, some hikes from here. But we are seeing then UK gilt yields on the rise.
All right, yeah, let's focus in on the banking story and the central bank story, because the governor of the Bank of England, Andrew Bailey, has been talking. We just saw him speaking for a little while. Let's go right now to Jenny Serrain, to talk about what we're hearing from Bailey and, you know, what we're going to hear later on. Of course, the Senate meets today to talk about bank safety, and the U.S. House of Congress meets tomorrow. So, Jenny, what do we hear from Andrew Bailey?
Yeah, you know, he'll be speaking this morning. I think he's going on right now. And I think one of the big things we're really planning to hear from him is just the nature of this bank run that Silicon Valley Bank endured, and how that changes things for regulators from here. You know, in the past, you would have had folks having to line up outside of branches and you know, wait for their physical cash. And that kind of put a lid on things and slowed things down, gave regulators time to respond, gave executives time to react. We didn't have that this time. You know, with a few clicks of the button, these clients were out the door in minutes. And so I think that's one of the big things that I think we'll be hearing from and have heard from Bailey on this week.
Yeah, good morning to you, Jennifer. And we're hearing from the PRA, the prudential regulator here in the UK, Sam Woods, also at this Treasury Select Committee, and talking about that very fact. We've got to look back at SVB outflow rates for lessons. And yes, as you say, Bailey has reflected on the speed at which these things can happen when it's at the click of a button and the word spreads really quickly. Just not such a visual story as the lines we used to get outside the banking sector. So that's what's going on in the UK. We're currently hearing from these banking regulators and key figures around the bailout of SVB, or the action they took around SVB UK. Let me ask you about what to look ahead to later on today then. We've got a Senate hearing. What do we expect?
Yeah, so we're actually expecting to hear from 3 of the top U.S. banking regulators. So you've got the Treasury, the Fed, the FDIC all there. And I think they're trying to send a couple of different messages. You know, the Treasury has said we are planning to emphasize that we want to ensure the safety of all American deposits. So they're really looking to kind of calm investors and depositors alike. The FDIC and the Fed have a bit of a different tact. You know, they're planning to come after the executives behind these banks. I think we heard from Fed Vice Chairman Michael Barr already saying, you know, this was a textbook case of mismanagement, and it looks like they're really going to be holding kind of the persons responsible and looking at the management of these banks.
All right, Jenny, thanks so much for that coverage. Obviously, a lot going on in terms of bank regulation. Let's get to another regulation story right now. Binance says a CFTC lawsuit against the crypto exchange and the CEO himself, CZ, is unexpected and disappointing. That's a direct quote. U.S. regulators allege that Binance and Zhao CZ routinely broke derivatives rules and should have registered with the agency years ago. Whether or not that's even possible wasn't discussed. Joining us now for more is Ana Herrera, Bloomberg senior crypto editor. Ana, it's a fascinating story because, you know, registering as a derivatives exchange is not exactly easy, and it's unlikely that the U.S. regulators would even let Binance do that. However, in the emails that we see shown in the complaint, they blatantly, looks like, tried to get around regulations.
Yeah, they clearly knew. Part of it is that they knew that they had U.S. clients, and you're not supposed to. I mean, you can make the argument that we could have applied, but you wouldn't have given us a license. But in the absence of that, you're still not supposed to have U.S. clients. So part of the complaint also had a lot of detail about, you know, the lack of KYC checks. And, you know, obviously part of that is like, who are you letting on the platform? Part of it was U.S. customers, but we also saw instances in which it seemed that they had potentially people who might have been using the platform for allegedly money laundering, or people that weren't using it for legit reasons. So it's quite a significant sort of document, the lawsuit, right?
So a lack of know your customer regulations and not effective anti-money laundering policy, just two of the things they suggest that the CFTC suggests that have been happening at Binance. But the CFTC is not the only regulator looking at Binance right now.
No, we've also reported that the SEC has been looking at them and the IRS as well. So obviously it's kind of like the full force of the U.S. authorities are looking at Binance, and Binance is the biggest crypto exchange by far. It's massive, you know. We talked about FTX a lot after it collapsed, but Binance is much bigger. It accounts for like the majority of trading in crypto. So, you know, it makes sense that U.S. authorities would look at it. And it's interesting because, as Matt, you were saying, can they actually go after them? Where are they based? Part of the complaint also said that they were kind of on purpose, sort of never basing themselves anywhere so that they couldn't sort of be chased. And obviously this is a lawsuit and these are allegations, and Binance have said that they sort of disagree.
Right, but of course, U.S. regulators tend to reach around the world, whether or not you think they should. Anna, thanks so much for joining us. Bloomberg's Anna Herrera will have much more on Binance later today on our Bloomberg Crypto Special. Tune in at 1 p.m. New York time, 6 p.m. in London for that. And of course, this is a story that will continue on over the next weeks and months, if not years. So we'll keep following it for you, of course. Now, let's get to geopolitics. Benjamin Netanyahu has delayed his controversial judicial reforms to prevent the country from being, quote, torn to shreds. It comes after tens of thousands of demonstrators took to the streets Monday night. Bloomberg Israel bureau chief and senior Middle East editor Ethan Bronner joins us now in Tel Aviv. So, Ethan, really dramatic scenes from those protests. I'm not sure how the counter-protests turned out, but what's the mood like in the country now?
Well, I think that you're right. Very dramatic push by one side, the secular liberal forces, the business forces that forced Netanyahu to back down, at least temporarily. But it does feel like a kind of victory for them. There are going to be negotiations led at the president's house now between the various sides to come up with a deal that everyone can live with. We'll see if that works. But what I think is clear is that the radical end of Netanyahu's government, who vowed that they would break the government up if this didn't happen now, were either bluffing or anyway defeated. And so that could affect going forward, too. It could be a more moderate thing going forward. We'll see.
OK, we've seen the Israeli shekel on the move as a result of this story. Ethan, thanks very much. Bloomberg's Ethan Bronner in Tel Aviv. Let's get to the French protest, driven by very different stories, but interesting to see what's happening in Paris and beyond. French unions strike nationwide once again today over President Emmanuel Macron's plan to raise the minimum retirement age by 2 years to 64. That's amid mounting concern over violence between protesters and riot police. For more on this, we'll bring in Bloomberg's Caroline Conan, who is in Paris for us. Caroline, what do we expect on this? Well, what number day of protests are we on now?
It is the 10th day of general strike in France since the middle of January, since the beginning of the union's action against this pension reform. And unions are expected to beat the number of last week, when you had about 1.1 million protesters in the streets across the country. What the unions and what the police does not want to see again today is the violence that you had on the sidelines last week with protesters and these so-called black blocs, these far-left groups clashing with the police. So you're going to have about 13,000 police officers, anti-riots squads across the country, more than 5,000 in Paris, trying to contain this violence. As you can see behind me, some of the shops, some of the banks, like this BNP Paribas branch behind me, have already barricaded themselves ahead of the protest this this afternoon. And we heard this morning from the unions, the CFDT, the moderate one, and also the more radical CGT unions who have called for Emmanuel Macron to pause this reform and start a mediation process in order to stop all this, in order to stop this cycle, because it's become very bad for the image of France.
Caroline, thanks very much. Caroline Conal there talking about the protests in Paris and around France in response to Emmanuel Macron's attempt to raise the retirement age, something that I think Western nations are all doing, but none seeing as much pushback as the French. We had breaking news this hour that Alibaba, a $220 billion Chinese business, is going to split into 6 units, and it's allowed to pursue corporate finance moves like IPOs whenever ready. Of course, Chinese authorities had clamped down. Jack Ma had disappeared, the founder and former CEO of Alibaba. Yesterday, it was reported that he reappeared in China. A lot going on in this story. If you look at the one-day GIP of this, it's quite dramatic. You just type GIP all into your Bloomberg terminal. But right now, we're looking at the shares jumping about 3.7% in the pre-market. So that's a story we're going to keep following. Some other stocks on the watch include the owner, the parent company of Calvin Klein and Tommy Hilfiger, PVH Corp, on the rise today, more than 12% in the pre-market, issued a stronger than expected forecast for revenue growth and earnings per share for the current year. So that's an interesting fashion mover there. Also, Lyft. Gaining in the pre-market. It rose in the aftermarket yesterday because right after the close, it tapped David Richard to be its new chief executive officer. He'll replace co-founder Logan Green, and that sets the stage for a potential sale because Lyft has really struggled with competition against Uber. So investors like that. The share's up 4% in the pre-market. By the way, look for our interview with the incoming CEO later on today. That's one you don't want to miss. And then we're also seeing Walgreens Boots Alliance shares on the rise. That trades here in the U.S., even though it sounds, at least to my ears, like such a British business after that takeover. Walgreens Boots Alliance expected to report results in just about an hour and 45 minutes. They optimistic view is that they'll recapture share of the prescription drug market. And of course, they're caught in the middle of a political storm on the Plan B abortion pill. But definitely watch for headlines coming out of WBA in just about 2 hours' time. And then on the downside, we have Albemarle Corp. It's the world's top lithium producer. You may not have heard about it, but it's based in Charlotte, North Carolina. And it's obviously a huge business, not only because of our cell phone batteries, but because of the batteries that are going to power the cars of really tomorrow, albeit some of them already today. It had a cash offer for an Australian developer, Liontown Resources, a $3.7 billion cash offer rejected. And as a result, those shares are down. Maybe investors fear it's going to have to offer more money. Anna?
Yeah, lots to watch in the pre-market then. Coming up on the program, Matt will talk to Maria Weitman, who is a senior multi-asset strategist at State Street Global Markets. She doesn't sound as bullish on stocks as she has done in the past. Fade the rallies could be the mantra. We'll talk to her shortly. And an exclusive interview with the Ukraine energy minister, or Ukraine's energy minister, I should say. He sits down with Maria Tadeo in Brussels. This is Bloomberg. Hello. All right. Okay. Okay.
Damn it. My mother has written to ask me where she should type GIP. I guess we didn't have a GIP of the Alibaba stock. Doesn't work? Yeah. I didn't think it would. I wasn't sure. But now my mom is pissed at me. She's like, stop using so much jargon.
It's what you really need, is feedback from your parents on your work life, isn't it?
Oh, I get it a lot. Yeah, exactly. It's great when your mom can watch you at work every day and
exactly.
offer a critique. God forbid I split an infinitive or use an improper antecedent.
Oh. I'll have to ask my children what that means.
Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller, based here in New York. Anna Edwards out in London. I'm looking at a chart, Anna, that shows what the market expects in terms of the Fed's terminal rate by the end of the year. And if you see the green line here, this indicates that there's about a 65 to 66% chance of a hike coming up, and then the market expects cuts after that. Maybe 2 or 3 cuts priced in, at least according to what we see in terms of Fed funds futures. Joining us now is Bloomberg Markets reporter Justina Lee to walk us through, what we should really expect, because a lot of this is hedging and a lot of this is, financial structuring. But we've heard from a number of people, Jeff Gundlach, Goldman Sachs, BlackRock, with other opinions about what the Fed is going to do with the rates by the end of the year. Justina, what do we know?
Yeah, it's interesting because all those people you just mentioned have conflicting opinions at this point. And we're kind of seeing this play out in markets as well. I mean, yesterday there was a big jump in banking stocks and front-end bond yields. And now Fed fund futures are actually starting to price in, possibly a 25 basis point rate hike coming up when it actually wasn't, counting on that at all before that. And I think what's really happening here is investors are realizing collectively that maybe they freaked out a little bit too much last week. But I think generally the narrative has moved quite a lot since, Silicon Valley Bank collapse. I mean, now everyone's kind of talking about recession even more now, because it does look like if there is stress in the banking system, and there certainly is, then that does mean that lenders are going to tighten their standards, and that will have an impact on economic growth.
Justina, thanks very much for the update. Bloomberg's Justina Lee with the latest on what markets are pricing in from the Fed, and certainly we're seeing that in other geographies as well. Certainly yields on the rise a little this morning. And for more market analysis, check out MLIV Go. That's the Markets Live blog on the Bloomberg terminal. This is Bloomberg. Welcome back. This is Bloomberg Surveillance Early Edition. Coming up on the program, we will speak to Maria Waitman, Senior Multi-Asset Strategist at State Street Global Markets. After the banking crisis, after the banking crisis, was it a crisis? Certainly was a drama. Can we get back to thinking about inflation? We'll get to that conversation. How high will yields go in that context? This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Bank of England governor testifies on the impact of the Silicon Valley Bank collapse, saying UK banks are in a strong position. Later today, US lawmakers face off with Fed, FDIC and Treasury officials over the bank failures. Binance says it's disappointed with that lawsuit from US regulators. The cryptocurrency exchange and the CEO, Changpeng Zhao, are accused of routinely breaking derivatives rules. And Israel's Prime Minister Benjamin Netanyahu is delaying a controversial plan to overhaul the judicial system. Still, thousands of demonstrators opposed to the plan were back on the streets overnight. I'm Anna Edwards in London with Matt Miller in New York. And Matt, it seems like a day that we're going to learn both in the UK and in the US a lot about the demise of SVB. So we're not exactly putting the bank story behind us, but markets trying to recover from it.
Yeah, well, markets seem to do a pretty good job of recovering from it yesterday, right? We had energy stocks rising in yesterday's trade, just followed by financials. So those were the top two gaining industry groups, and that's a real turnaround from what we've seen the last couple of weeks. We do see very little change on S&P futures right now. So we're stuck at a gain of 1/100th of 1%, but we were down a little bit earlier. So we got a little bit of positive impetus from that Alibaba headline that they will break into 6 units and be able to pursue an IPO when they're ready. But it doesn't seem to have moved the needle that much. On the other hand, investors are selling out of 10-year treasuries. So that's a good sign, right? Because they're not necessarily seeking the safety, the perceived safety of government debt. I think we can drop perceived, right? It's pretty safe. Your money's good in treasuries, at least if you're holding to maturity, right? If you're in that position. If you don't have the ability to do that, if you have to meet, for example, depositor withdrawals, you should really watch that kind of portfolio. And maybe regulators should have kept an eye on that as well. NYMEX crude up 42 cents a barrel, so a little bit more optimism for the global economy coming into the crude market. It was actually kind of weird to see it trading so far down. We were well under 70 yesterday. Brent had gone down to almost $70 a barrel, and I think it snapped back up to $77, $78 yesterday. So that will be good news for the global economic outlook, or at least that's what it signifies, and also good news, obviously, for the oil producers. So watch, for example, Oxy here, and then pretty much all of the big heavyweights on the FTSE. Bitcoin is down $65 to just under 27,000. This is understandable after the CFTC lawsuit against Binance. You saw the collapse of FTX and then wondered, why is Bitcoin rallying from 16,000 back up to 28 grand? Now, with Binance under threat, it's more understandable that there's some pressure, but still it seems fairly strong for that story. Take a look at some of the pre-market movers. I mentioned Alibaba, obviously a gigantic Chinese tech stock, but of course its primary listing is here in New York. So it's up 4.5% in the pre-market on those headlines that it's going to break into 6 units. Also, I guess on some optimism because Jack Ma reportedly showed up back in China again yesterday, and then it's allowed to pursue an IPO when it likes. We also see a gain in PVH Corp, which is the owner of Calvin Klein and Tommy Hilfiger. It's basically a fashion brand that issued a stronger than expected forecast for revenue growth and for earnings this year. Obviously, investors like that. The shares are up 12% in the pre-market, so watch it at the open. Watch Lyft as well. Gaining a little bit more now in the pre-market, 4.7%. They said they're going to have a new CEO, David Risher. We're going to have an interview with him later on today, so definitely stay tuned for that. He replaces the co-founder who has been the CEO up until now, Logan Green, and that sets the stage for the potential sale of the company as it struggles to compete with gigantic rival Uber. Then you got Walgreens Boots Alliance coming out with earnings in just about an hour and a half. The optimistic view is that they will recapture market share in the prescription drug market, but of course we'll know for sure at 7 a.m. New York time, which is now it's again noon in London.
5 hours.
Yes, yes. Thank you very much.
We are,
Anna,
we are back. We are back this week to the 5-hour gap. That's what we need to know. Situation back to normal, Matt. That we can make sense of. So what we're seeing in Europe, which I know is what you were about to ask me, we're seeing this. We're seeing gains, but not by much. We're up for another day here in Europe after the heavy selling during Friday's session. All of that was focused very much around the banking sector. So we've done some of the work in trying to recoup some of the losses of Friday. Here in the bank stocks, we don't want to take our eyes off them for too long, given that we are seeing these SVB hearings taking place in the UK and over in the United States. And I'm sure, Matt, regulators will be keenly paying attention to the advice you just gave them a little earlier about things they need to watch. Here's the energy names. These are on the rise as a result of a much stronger oil price over the last couple of days. Modest gains today, but more than 5% higher on WTI in just yesterday's session. Yes, there's some idiosyncrasies surrounding supply of oil through Turkish pipelines and a Turkish port, but there are broader stories about Chinese demand returning. So that's the bank sector, that's the energy names, and this is the UK yield. We're up by 11 basis points, and in fact, Matt, we're seeing this across a number of geographies here in Europe and also in the US. A sense perhaps that investors maybe freaked out a little too much, to use the words that we heard from our colleague Justina Lee earlier on, in their reaction to the banking crisis. And now a realization once again that if we're through any banking crisis, then we're back to fighting inflation. And does that mean higher rates?
Yeah, let's talk about that, exactly that right now with Maria Faimana. She is State Street Global Markets Senior Multi-Asset Strategist. Maria, great to have you on the program. Thanks for joining us. You know, I confess to being pretty terrified when all of this bank stuff happened, SVB and then Credit Suisse. I felt a little bit better when the ECB showed at least that it can still raise rates 50 basis points, and then the Fed coming out with 25 basis points. Now, I think I've restored my calm. I'm much more zen-like, back to normal. Is all of this behind us?
Yes. Hello. I mean, I share your sentiment that we can restore some calm, but not sure all is behind, in a sense that we still have inflation problems. That has not gone away. I mean, if you remember, times three weeks ago when we didn't hear about banking crisis, if that's possible, we were worried about 50 basis point hike, and we had very strong data. And I know not many people been kind of on a data watch, but if you look at things like city economic surprises, the US data has been coming even stronger than before. So this idea that we avoided banking crisis is true, but what we have, like Anna was saying, is that we're back to inflation fighting, and I think that that's really important. And what we'll have with PCE data is coming on Thursday. That really is a key number for us to watch.
Well, they're only raising now in increments of 25. That seems minuscule compared to the 75 bips we were seeing, and it seems like they're almost done, right? So. As the Fed gets near the end of this and they become very careful, concerned that they don't want to break anything else, should markets be ebullient? I mean, we're back to 4,000 on the S&P already.
Well, I was concerned about possibility of recession before banking crisis, because our kind of central story has been that inflation is still very sticky, labor market is still very strong. So even if Fed is close to kind of top of the hiking cycle, it's still very far away from cuts. So our expectation was that Fed will have to stay keep policy very tight for a long time. So that was kind of prior to banking crisis. Now we have this big shock, and Fed is concerned about kind of breaking something. So to me, the path to avoiding recession or soft landing is much more complicated. So it's either they've already broken something and we're going into recession, or they haven't and they will in the future, because inflation is still there. So to me, recession probability is very high and rising.
So now is it just a question of timing that recession, Maria, and working out which sectors you want to get exposure to at various stages of the US cycle?
Yeah, no, absolutely. And for us, the longer this idea still holds true, the longer we avoid recession, the deeper it's likely to be, because by that time, more things will break. And so in terms of kind of equity market investments, it's really finding out those places where recession will maybe bite less. And in that sense, I mean, for me, for us, the key trade has been for some time is preference for growth over value, because recession is really going to stress value stocks, and the fact that they may be trading at low multiples is not going to provide any respite. It's about where we can see ability to withstand kind of slower economic growth.
And what about emerging markets, Maria? I mean, at a time when we have seen recently, of course, great tension in developed markets because of the banking sector, and you're looking for havens all over the place. Maybe that crisis period has passed, or maybe we're through the worst of it. But what about the emerging market space then? Is this a good time to look at alternatives?
Yeah, no, that's a really interesting point, because normally emerging markets is like very high beta, and you worry about if you're in a crisis, and emerging market is one of obvious places to avoid. I mean, right now, what we know is that investors, particularly in emerging market stocks, are still heavily underweight. We know they've been avoiding particularly Asian market for years and years. And I mean, last year we've been discussing whether China is at all investable, and now we have reopening. It might be not going as fast as people like, but we know that reopening is happening, and we know that investors are really underweight this region, and we can begin to think about kind of structural improvement there. So emerging markets, ironically, is a very interesting place to be.
Maria, you are typically, if not bullish, enthusiastic, high energy. You clearly love your job, right? It's so exciting. What gets you going in the morning now, especially if you expect stock markets to be choppy going forward? There's no clear direction. There's so much uncertainty. What's something that really gets you moved to go to work and do your job?
Well, not sure about waking up in the morning being excited about going to work, but in general, I think this year is not about absolute direction for stock market. I mean, we were quite skeptical, but in terms of where the opportunities, it's relative bets. I mean, I mentioned preference for growth over value. I mean, I've been a skeptic of banks, as you know, for a long time. Obviously, not predicting the crisis, but we're really concerned about the kind of long-term profitability of that. We'll avoid it. Instead, actually, I've been talking to my clients about tech stocks recently. I think that's an interesting space. I mean, obviously, it's long duration, and if rates are maybe not as going up as much as people fear, then that's good. But looking at earnings outlook, actually, it's really interesting. In US, tech stocks are the only sector that is seeing consensus earnings upgrades recently. So to me, that's exciting. So if maybe that sector can avoid like big earnings collapse and and interest rates are not going too high, that's an interesting place to be. So maybe preference for tech over banks can continue. So that could be a good opportunity for people.
Okay, there you go, Matt. There's your answer. The reasons to get up in the morning. Maria Weitman, thank you very much for joining us. So State Street Global Markets with thoughts on tech and banking and much beyond. Coming up on this program, an exclusive interview with Ukraine's energy minister. He sits down with Maria Tadeo in Brussels next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller here in New York with Anna Edwards out in London. Let's get now, though, to Brussels, where Bloomberg's Maria Tadeo is sitting down for an exclusive interview with the energy minister of Ukraine. Maria?
Yes, Matt, good morning. And we're joined by Herman Galushchenko. Thank you so much for being with us on Bloomberg. Sir, I know you are meeting with your European counterparts today, and you want to talk about energy. But before that, I want to ask you about the general picture, because we've had the Chinese leader going to Russia. Vladimir Putin made this announcement that he's going to maybe station tactical nuclear weapons in Belarus, and yet this phone call between China and Ukraine has not happened. Are you worried?
I would say, of course, that is another announcement about the nuclear weapon, and no matter whether it's tactical or not, but they now are really control the another very important nuclear assets, which is Zaporizhzhia nuclear station, and that is the biggest in Europe. And so I really worried about these things. I might say even more about than these threats to let's say to put this nuclear weapon in Belarus or wherever.
You worry more about the situation in Zaporizhzhia than, and just to explain to an international audience, this is a Ukrainian power station in Ukrainian territory, but it's occupied and now handled by Russian forces. There is fighting around it and there's shelling around it. The Atomic Agency says this is playing with fire. This is very serious. So what's going to happen next in the next few hours?
And that is right. I mean, and the situation, it's more than 1 year already under occupation, because it was occupied from the night from the 3rd to 4th of March last year. And of course, the situation is become worse and worse, and that is confirmed by AIA. By the way, yesterday, Rafael Grossi was in Ukraine. He had a meeting with the President Zelensky.
And he said it's almost nuclear blackmail, what's going on. Those are very strong words.
And that is real blackmail, because they control the station, because they operate the station in the wrong way. And we understand that even because of the shellings of the lines which connected station to Ukrainian energy system, because today Ukraine supply electricity for safety or maintenance of the station. And due to these shellings, the station was 6 times in blackout, 6 times. So it means that blackout of the station is only one step to Fukushima scenario.
And would you say Russia is willing to risk that scenario? Or is there a red line? They also understand this is dangerous for us too.
You know, there are Russian representatives on the station. There are guys from Rosatom who are on the station. So, of course, they know what they are doing. I mean, they know the risk. When they shell the lines, we could imagine that they do not know the risk. Of course, they know the risk. And that is, I must say, even more dangerous than all the threats that we would put nuclear weapons somewhere. So because it's today they already control the station, and that is 6 units. That is the biggest station in Europe.
And you're here obviously to talk with your European counterparts. Ukraine has made no secret you want to join the EU, and I want to talk about specifically energy, because we've seen this cut from Russian gas, oil, but there's now LNG. Is that something in your conversations that you're trying to force member states of the EU to say don't touch that, even on a voluntary basis, just don't do it?
Yeah, of course, we discussed the sanctions, and that is a very important issue.
You want that in the next package?
Yeah. Of course, we want LNG. We want to strengthen the sanctions, which already do. For instance, when we are talking about the price caps on oil, so we have a lot of things to discuss. And what is also very important, following our discussion now, that is the sanction on nuclear. So I understand all difficulties, we understand everything, but we need to at least to start these sanctions against nuclear, because they are playing these games and there is no response. I mean, nothing.
And they seem to obviously use that at times to increase the pressure on Ukraine. I do want to ask you, however, you mentioned it yourself, the price cap on oil. Obviously, that was capped a few months ago. Where do you want to see it now? I know a number of countries say $30, $40. That's possibly...
I think 30, it's quite fair.
That's what you're pushing for?
So, of course, we will ask this.
And what countries in Europe would say yes?
So I think,
of
course, it's difficult discussion. I understand difficult discussion inside the European countries, and we see this discussion, of course, but we understand that the importance of sanctions, not because we have sanctions. So we need to have efficient sanctions. If we have sanctions which allowed Russians to earn money, so they spend this money to produce new weapon to kill more Ukrainians, and that is the obvious circle, So we should be fair. So our task is not to allow them to escape from sanctions.
And that's a whole talk about the circumvention of sanctions that the European Union says it wants to focus on. I have to ask you a question, which I understand is delicate, especially when you're Ukrainian. This is your country. Obviously, you're attached to it. But it's been a year now. We see that Russia's still not leaving. They give no indications that they want to leave. For Ukraine, this counteroffensive, for the time being, has not manifested. Do you fear potentially that you're losing some momentum here? Is that something that concerns you? And is that why you're here, to say do not forget about Ukraine?
I don't have this feeling. I mean that because
you feel just as supported as you were before.
Yeah, I feel support. I can tell you that. I mean, especially in the energy sector, because what is happening? I mean, from the 10th of October, they started everyday shelling our energy system. It was the beginning of the heating season. It was the incredible challenging for Ukraine, and we managed to withstood. And all this time, I feel the support from my colleagues, from the minister, from many countries, and that is really give us more strength to go ahead.
And I can say that I've seen that resilience firsthand when I was in Ukraine very recently. Thank you so much for being with us, sir. I know it's a busy day for you, so we appreciate your time on Bloomberg TV. And of course, that was Ukraine's Energy Minister, Galushchenko. Thank you so much.
Maria, thank you very much. Maria Tadeo bringing us that important conversation around energy and Ukraine. Coming up on the programme, we'll run you through the major events that we need to watch out for in your trading day ahead. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Let's have a look at what is ahead for us today. At 8:30 a.m. we get US wholesale inventories. Then at 10 a.m. Eastern Time, US consumer confidence data will be due out. Bloomberg Intelligence predicts the March data will show a modest deterioration after being shaken by the banking sector turmoil. Also at 10 a.m. the Senate Banking Committee will hold the first of several hearings on the collapse of Silicon Valley Bank and Signature Bank. After the bell, it'll will be time for some earnings. Micron Technology is scheduled to report its second quarter results. Analysts expect the report to reflect ongoing weakness in the market for memory chips. Quite a lot going on today, Matt, even if we feel like we might be on the other side of the eye of the storm, at least, of that financial drama. Interesting that stocks losing their nerve a little bit, though, as we head into the latter part of the morning here in Europe. We're pretty flat, almost entirely flat on European stocks right now.
Yeah, and we're pretty flat in the U.S. as well. We have S&P futures right now down about 0.04%. I think it's fair to call that unchanged. Nonetheless, we're at a relatively strong level. 39.77 was the close yesterday after we gained about 0.2%. So considering what looked like catastrophic banking turmoil, you know, not only SVB and Signature, but also the demise of Credit Suisse and the forced sale of UBS, I feel like these markets have done relatively well. Out of the last 4 weeks, we're up 3 in 4. So not bad.
And we'll see what we learn about SVB and its demise in the United States later. We've learned a little bit about the UK perspective here. The Bank of England Governor Andrew Bailey saying this morning global markets are testing quite a lot of the banking sector. And it's not fundamental weaknesses around specific banks that he thinks is happening here. Maybe he was talking more about the European story there, but maybe sort of perceived weaknesses and where the market is therefore testing the banks. But over to the US a little later. We'll be listening carefully to see what we learn about SVB there. That is it for early editions. Surveillance is still ahead. They'll be hearing from Katrina Dudley of Franklin Mutual, among other voices, of course. More on the markets shortly. This is Bloomberg.